Most people who are not investing yet are not waiting because they do not want to invest. They are waiting because they think they do not have enough money to start. They are waiting until they have a spare £500 or £1,000 or until the market looks right or until they understand it better. And in the meantime, every single month they are not invested is a month of compound growth they will never get back. You can start investing in the UK today with £100. By the end of this video, you will know exactly how to do it step by step, from opening an account to making your first investment in less time than it takes to watch a Netflix episode. The amount you start with matters far less than most people think. What matters most is time. The earlier you start, the longer your money has to compound, and compounding is not a gradual linear process. It accelerates over time. The difference between starting at 25 and starting at 35 is not 10 years of returns. It is a fundamentally different financial outcome. Let's put a number on it. If you invest £100 per month from age 25 at a 7% average annual return, by age 65, you have approximately £262,000. If you start the same £100 per month at age 35, you have approximately £122,000 by age 65. Same monthly amount, same return. 10 years difference in start date, £140,000 difference in outcome. That gap is not explained by the £12,000 of additional contributions made between ages 25 and 35. It is explained by the compound growth on those early contributions having an extra decade to grow. The first £100 you invest today is worth more to your future self than £200 you invest in 5 years. This is why starting with £100 is not a consolation prize for people who cannot afford more. It is the right move for anyone who is not already investing, regardless of what they plan to add later. The first step is deciding where to hold your investment. For UK investors, the answer for most beginners is a stocks and shares ISA. As we covered earlier in this series, a stocks and shares ISA gives your investments a tax-free wrapper. Any growth, dividends or returns inside the ISA are completely free of UK tax. You get £20,000 of ISA allowance every tax year, and there is no tax to pay when you take money out. Investing outside an ISA is possible, but introduces capital gains tax and dividend tax complications that are unnecessary for most beginners. Always use your ISA allowance first before investing in a general investment account. We covered UK investing platforms in detail in the previous video. For someone starting with £100, the most appropriate options are as follows. Vanguard. If you want maximum simplicity and you are happy investing in Vanguard's own funds, open a stocks and shares ISA directly on Vanguard's platform. Minimum investment is £100 as a lump sum or £1 per month on a regular savings plan. Trading 212. If you want to start with less than £100 or want zero platform fees, Trading 212 allows investing from £1 with no platform charge. The fund range is ETF based rather than traditional index funds, but the investment outcome is equivalent. Invest Engine. If you want a zero-fee ETF platform with a slightly wider ETF range than Trading 212, Invest Engine is a strong alternative with no minimum investment and no platform fees. Pick one. Do not spend weeks comparing them. The difference in outcome between these three platforms over a decade of consistent investing is far smaller than the difference between starting today and starting in 3 months. For a complete beginner investing £100 for the first time, the investment decision is simple. One globally diversified index fund or ETF. That is it. If you're on Vanguard's platform, the Vanguard FTSE Global, All Cap Index Fund, or the Vanguard Life Strategy 80% Equity Fund are both excellent starting points. The Global All Cap gives you exposure to over 7,000 companies worldwide. The Life Strategy 80% adds a 20% bond allocation for slightly lower volatility. If you are on Trading 212 or Invest Engine, the Vanguard FTSE All World ETF or the iShares Core MSCI World ETF achieve a similar result in ETF format. Both track thousands of companies globally at very low cost. Do not try to pick individual stocks with your first £100. Do not buy a themed fund focused on a specific sector like technology or clean energy. Do not split £100 across 5 different funds. One global index fund, simple, diversified, low cost. Everything else can come later as your knowledge and portfolio grow. Once your account is open and funded, making your first investment takes less than 5 minutes on any of the platforms we have covered. On Vanguard, log in, select your ISA, click Invest, search for your chosen fund by name, enter the amount, confirm, done. On Trading 212, log in, select your ISA, use the search bar to find your chosen ETF by name or ticker, enter the amount in pounds, confirm. The fractional share feature means your full £100 is invested even if the ETF price is higher than £100 per unit. On Invest Engine, log in, select your ISA, Browse or search for your chosen ETF, enter the amount, confirm. The first time you do this, it might feel significant. It should. You're starting something that could genuinely change your financial future. After the second or third time, it will feel completely routine, which is exactly how it should feel. Investing should be boring. Boring means consistent. Consistent means results. The single most important thing you can do after making your first investment is to set up a regular monthly contribution so you never have to make the decision again. On Vanguard, you can set up a direct debit that automatically invests a fixed amount on a set date every month. Choose the same fund you just invested in, choose an amount you can commit to comfortably, and set the date to shortly after your payday. On Trading 212 and Invest Engine, you can set up auto invest features that work similarly, automatically purchasing your chosen ETF on a regular schedule. Once this is set up, your investment habit is automated. Money leaves your account on payday and goes straight into your ISA and into your chosen fund without you having to do anything. You're investing whether the market is up or down, whether you feel confident or nervous, whether you remember to do it or not. This is pound cost averaging, buying consistently regardless of price, and it is one of the most effective long-term investing strategies available to individual investors. Let's finish with the numbers that make this worth doing. £100 per month invested from age 25 at 7%. Average annual return grows to approximately £262,000 by age 65. £100 per month from age 30 grows to approximately £182,000 by age 65. £100 per month from age 35 grows to approximately £122,000 by age 65. Now imagine that over time, your income grows and you increase your monthly contribution from £100 to £150, then £200, then £300 as your salary rises. The compound effect of increasing contributions on top of an already growing portfolio becomes very significant indeed. The point is not that £100 per month will make you rich. It will not on its own. The point is that £100 per month builds the habit, the account history, and the compounding foundation that every future contribution will build on top of. Starting is the hardest part. Everything after that is just keeping going. To bring it all together, starting with £100 is not about the £100, it is about starting. Open a stocks and shares ISA on Vanguard, Trading 212 or Invest Engine. Choose one globally diversified index fund or ETF. Invest your £100. Set up a monthly contribution for whatever you can comfortably afford, and then leave it alone and let compound growth do its work. The best time to start was 10 years ago, the second best time is today. If this video gave you the push you needed to make your first investment, subscribing takes 2 seconds and means you won't miss a video. We post twice a week on making your money work harder in the UK, and that wraps up our investing series. Next up, we are starting the Hidden Gem series, beginning with income protection insurance, the most overlooked financial product in the UK.